what is sort of the potential? What are we looking at here? Like, you invest a certain amount, or that company starts at, let's say, you said $250,000. What can I expect?
Yep. Yeah. So there's a couple different ways to look at this. This is an interesting play for most investors because really the value is in the holding. So Barry talked about it a second ago, is that the way investors make money, the team, by the way, the structure is the same across the team, advisors, and the investors. It's all the same. The way we have our upside is when the portfolio companies go through a transaction, right? So they're bought. They could go public, but we think in most cases they'll be bought. So when that happens, we get a return at the studio level, and then we distribute those proceeds. So just based on the distributions alone, we're projecting anywhere from 4 to 8 times your investment over 5 years. And then over 10 years, it really jumps up to between 24 and 55 times your investment. So, those are big numbers, right? And even if we're half right, everyone's going to be extremely happy. But that's just the distribution. So that doesn't even factor in the value of the equity that you'd own in the studio for a machine making distributions like that, right? Because as you can imagine, if you own stock in something that's making distributions like that, that stock in and of itself is worth a lot of money. So it's a pretty interesting model. Like Barry said, I had not seen or heard of anything like it before I joined. And for investors, it's got a lot of potential for upside.